Well, hello everybody, and welcome to today's webinar on Social Security 101. Now, Social Security 101 means some basic stuff, but we're also getting into some very in-depth stuff today on some Social Security. My name is Mark Roberts. I'm what you call a financial advisor, but in reality, what I am is a fiduciary, which is also known as a professional money manager. I own several financial companies here in town, as well as a couple of nonprofits. Today, I'm taking my financial advisor hat off and putting on my nonprofit hat. And today I'm here to represent my nonprofit. I'm the director of F3E, that stands for the Foundation for Financial Education. We created this nonprofit as a way to give back to our community to talk about financial topics that are very relevant, topics that we all need to have for retirement, getting ready for retirement, being in retirement mode, but topics that most financial advisors and most home offices don't ever talk about. And so we do this for our nonprofit so that we can do this with educating our community, give back to our community, but without having to try to sell anything. We're not trying to pitch a product or that sort of stuff. So probably we find that most financial advisors don't talk about Social Security, they don't talk about taxes, because it's very much common in our industry for home offices to tell the advisors to not sell or to not discuss Social Security and to not discuss taxes. Those are two things that you can't really sell product for. And at the end of the day, a financial advisor is really about selling investment products and managing those investment products. Some advisors will do a financial plan, create income streams, but when it comes to tax planning, you go to your CPA, not your financial advisor. When it comes to Social Security, you're kind of on your own. But we don't believe in that. Those are a lot of things that are all intertwined together, and Social Security and taxes being two big pieces that are intertwined with everything in retirement. So today you're going to get a lot of information on Social Security. Some basic stuff and some more complex, but then I'm also going to talk about taxes. The first 75% of our presentation is on Social Security. The last 25% is on taxes. And the reason why I'm putting taxes in here is because when we do this, they kind of intertwine super close together for retirement, taxes and Social Security. But after today's webinar, you want to have a conversation with us one-on-one. If I get you myself, typically one of the first questions I always like to ask is, hey, after you listen to our Social Security webinar, what was your favorite part, the Social Security part or the tax part? And I'd really tell you 9 times out of 10, people would say it's the tax part. They say that was way more impactful, and I'm really glad that I put that in at the end of this. So today I'm going to go for about 1:15 to 1:20. Can't do this in an hour. I apologize. There's just no way to do this in 1 hour. There's just too much information. But I am very good at putting this in layman's terms. Okay, so sit back, relax. Write down lots of notes as you want to. I'm just going to tell you we're not going to be selling any product. We're not going to pitch any product here today. Our follow-up appointments afterwards, we're not selling product there either. It's ask you questions, getting to know you so that we can do the Social Security and the tax analysis for you, and it doesn't have anything to do with us trying to sell products to you. So we're going to put we're going to take our financial advisor hat off and put our nonprofit hat on today. All right, so I get a lot of notoriety. Been doing this now for 24 years. I work with financial advisors all over the United States. I mentor and coach financial advisors, and I also get the opportunity to do a lot of public speaking in front of financial advisors. I do public speaking in my area here in front of people in the Kansas City area. But we also talk about things in retirement, investments, taxes, Social Security. There's a lot of things to talk about, but today it's Social Security and taxes. So I've been in newspapers, I've been in magazines, I've been on the radio, been out there lots of places, but this is a book that I wrote 4 years ago. It's titled Why Didn't I Hear About This Earlier? And I know that's kind of a bit of a goofy name, but I wrote the name to the book, Why Didn't I Hear About This Earlier? Because honestly, that's really probably the most common question people ask me. Well, gosh, Mark, if it's that easy, why isn't my financial advisor telling me this? Mark, if it's that easy, why doesn't my CPA tell me this? And Mark, if it's that easy, why doesn't the HR department at my company not tell me about this? Well, the reason why is because advisors and CPAs, they don't do this stuff. They don't work with Social Security, and most financial advisors and CPAs don't work with taxes. And when I say CPAs and taxes, what I'm referring to is the CPAs really want to help you with taxes and what you can do to save taxes this year and primarily last year's tax return. What I'm talking about doing on taxes is things you can do right now, things you'll be doing over the next 5 or 10 years of your life to save you income taxes for the rest of your life, and then save taxes to your surviving spouse, and then save taxes to your kids when they ultimately inherit this. So that's going to be the best part of the presentation. That's probably the last 25% is that. I'm not trying to sell my book. I'm just trying to give you some credibility as to who I am going to be speaking in front of you for the next 1:15. So shortly after we created the book, it also went to Amazon's bestseller list. That's a huge honor for us. All right, so let's jump into this here. This is a Social Security analysis calculator here. If you go out and you Google Social Security calculators. You get a whole bunch of them out there for free, but it's really only taking into account like you and just your information only. But if you're married or you've ever been married, you've been married and divorced, married and widowed, remarried, if you've ever been married, there are 567 Social Security strategies. There is a lot. So it's not just as simple, do I start it at 62? Do I start it maybe at 65? Do I start it maybe at 70? There's a ton more variables in that. So this analysis is the only analysis I've ever come across in 24 years, excuse me, that takes into account all 567 strategies for both you and your spouse, or for you and working with the next spouse, like a divorced spouse or a deceased spouse. And what it does is it will take information like, okay, here's the wife's earnings information, here's the husband's earnings. And it's going to say, hey, if you died at the age of 90, and we can pick different dates of death, but if you both started your Social Security at 62, it's going to tell me that you're going to live and collect $1,065,000 in your lifetime between the two of you. If you both started Social Security at your full retirement age, $1,229,000. If you wait until 70, $1,274,000. You see, the longer you delay taking it, the check gets bigger. I'm going to collect more money. And then here's the last one: is a hybrid approach. And a hybrid approach obviously is even more money, $1,317,000. What the hybrid approach in this particular example is saying, we want the husband to start his Social Security on himself at 70. We want the wife to start her Social Security on herself at 66. But when her husband goes in and files at age 70, she's going to go in with him. She's going to refile. She's going to do a switcheroo, stop collecting off of herself. She's going to start collecting on him right here, as you can see right there in green. And now she's going to switch over to taking his, because that's going to be more money for them to do that. Now, that's just one really hypothetical, simple example that we can show you, and there's a whole lot more. So I've got a lot of stories. And again, I've been doing this for 24 years. Let me tell you the first story about a guy that I was in a workshop, public, room full of people, like 60, 65 people in the room. Guy was in the front left corner, had lots of questions to ask. And so I asked him to hold his questions until the end. And at the very end, when we're ready to do the Q&A session, he basically stood up and he turned his back to me and he talked to the audience. Now, that's unusual for people who usually ask their question directly to me. What it was is he really didn't have a question, he had a story. And the story is he scheduled an appointment, he went into the local Social Security office, asked some questions, lady did some calculations and basically says, here you go, sign this form and it'll start in 90 days. And he looked at that and he thought, wait a second, that doesn't seem right. I thought I was going to get more than this. But he didn't know what questions to ask. He just knew that he was expecting to get more than this. Now, is it because of Medicare premiums? Is it because of taxes? He was remembering on his Social Security statement that he gets every year. He thought it was going to be more than that. So he didn't sign. He left. He went home and he Googled, looked up some information, got some more information on Social Security, came back in for a second appointment, asked more questions, got some same answers, got some additional answers. Here you go, sir, sign this, and it'll start in 90 days. And he found out that that's a different amount. And it was a higher amount the second time around because he asked more questions on what to do. And what we found out from that is I asked him, well, which one did you sign, the first or the second one? He says, I didn't sign either one. Now, that's really the best part of the story is he said, I went home, not signing the second one because I wanted to go home and do some more Googling and come back for a third time. And I asked him, why did you not sign after the second one when the second one was bigger? His answer was, which I thought was the best part of the story, he said, what if the second person told me wrong and the first person told me correct, and I'm actually collecting more money from Social Security than I'm supposed to? Later down the road, what if Social Security audits this and catches up to me that they've been accidentally overpaying me for a while, and now my income's going to drop because they've caught up to their mistake? I didn't want that to happen. That's a great answer. So did some more Googling, came back for a third appointment, got some more information, signed up for Social Security after that third appointment, felt good and left. Now he's at my webinar now, because now fast forward a little bit more into the future here. Now his wife is about ready to sign up for Social Security, and they want to come to this workshop that we had in person, want to bring his wife, and hopes that when she goes in for Social Security to sign up, that it's not going to be as difficult for her to get information to sign up, and she won't have to come back 3 times. Hopefully she's just going to do it the first time. So after they came to the workshop, they scheduled an appointment. We had a one-on-one conversation, and in doing so, what we did was we answered their questions, and I did this Social Security analysis that you're seeing right here, did it for them. So we gave her instructions as to what to go do, and we gave him instructions that there's something he should be doing that's different, that was better for them. So when she goes in for her Social Security to sign up, he's going to go with her and get his amended, and it worked out much better for him this way. So I'm going to tell you this because we're going to get into a lot of things on Social Security. I'll probably tell you a few stories. There's on your screen, there's a Q&A button. you want to ask a question, please feel free to do so. Just ask that question, type it up in the Q&A section, and then ask that to me. Again, 567 ways. I won't be able to answer all of your questions, but I'll do my best to get through as many of them as I can. All I ask is make your question be a question, not a story, please. And then secondly, try not to give me too much personal information, because without knowing you, I can't really give you very specifics, but I can give you very good general answers today. If you have questions that you want to ask us, or questions that you put on the screen and I just can't get to them all, don't worry about it. We will get all of your questions answered in that next appointment. We will have an appointment following this webinar. In fact, here's an example of that. So right now you'll see this. You'll see it a second time later in the presentation. You'll see it a third time at the end of the presentation. And we're going to see it as an opportunity to schedule a one-on-one appointment with me or one of my financial educators that's here representing F3E, our nonprofit. My commitment to you is this. You schedule to have an appointment with us. We need to have a conversation at first to gather some information from you, probably answer some questions you have too. And we need some time to work on it to put together the analysis, the Social Security analysis as well as the tax analysis. And I'll show you those both again a little bit later throughout the presentation. We're not pitching any products today, and we're not going to be pitching any products in those follow-up appointments afterwards either. So ask lots of questions because we want to get those answered. But here's how you schedule an appointment. There's a box here that allows you to schedule an appointment with us. And you'll first go and select a day. Then you'll select a time of day that you want. You need to put in some basic information like your name, your email address. We need to get your cell phone number. That way we need to call you back and confirm that you're with us. And then you'll get a confirmation. It's important that we connect with you after you schedule, because sometimes, the first conversation just needs to be on the phone. Maybe you want to do a Zoom conversation through the computer like this, or maybe you want to come in person face-to-face. I usually recommend that first conversation be either just a phone call or a Zoom so that we can answer some of your basic questions and then also gather some information from you so we can put together the analysis. The follow-up meetings after that, I recommend then we can either do Zoom or, more importantly, I prefer to do face-to-face. Those are usually the best. That way we can go over the analysis with you, give you copies of it. Again, no products being pitched. It's kind of our way to give back here. So let's jump into this here. Now, we're going to start with Social Security, but I love this quote because this quote applies to several different things. This quote was by Judge Leonard Hand of the U.S. Court of Appeals in the 2nd District. There are two systems of taxation in our country, one for the informed and one for the uninformed. Informed, uninformed. Now, you know as well as I do, there's not two tax systems. There's only one tax system. But basically, it boils down to people who are educated can do things that people who are uneducated can't. And I'm not talking about how smart you are. I'm just you learning more on this particular topic. I find, again, financial advisors a lot of times give advice primarily around to sell product. And there's a lot of advice I think people need on Social Security and taxes that don't have anything to do with product, but it's very important. And that stuff is not being addressed out there. And so that's why we do this through our nonprofit. So what's the difference between, let's say, an average American versus maybe a wealthy American? And I'm not talking about the wealthy American has more money. What I'm talking about is the wealthy person has more people. The wealthy people pay more people. They have access to more people like me to give them advice so that they can take advantage of what the laws are. You know the rules to the game, and you can figure out strategies to stay within inside those rules to maximize your Social Security and to minimize your tax. All right, so let's jump in here. Several parts of the presentation I'm going to recommend that you take down some notes, and this is definitely a page I want you to take down notes. So write down on your piece of paper 0, 50, 85%. And what this is how our Social Security is taxed. How Social Security is taxed. If your income is from right here and below, your entire Social Security check will not be taxed. It's tax-free. The entire check is tax-free. But if your income is from here to here, now 50% of your Social Security is taxed, but 50% is tax-free. Now, what I mean by that is take your total income sources. Maybe your job, your full-time job, your part-time job, your spouse's job, pension, Social Security, IRA withdrawals, investment withdrawals, rental property, wherever you have your income coming in that goes on your tax return. If your income falls in this middle bracket right here, now half of your Social Security will be taxed, but half is tax-free. And how much tax do I pay, Mark? Well, that's typically going to boil down to the overall where your tax bracket is with your other income sources. That tax bracket you're paying on that is what you will pay on 50% of your Social Security. So 50% will be taxed at that bracket, but 50% will always be tax-free. And then if your income is from, let's say, here and above, now 85% of your Social Security is taxed, meaning 15% is always tax-free. Now, why this is very relevant and why it's important for us to do a Social Security analysis and a tax analysis for you It's to, one, make sure that you never run out of money, and two, make sure that you're maximizing Social Security, three, try to minimize tax. And those two things, of course, help the longevity of your money, maximizing Social Security, minimizing tax. So I have clients all the time who are retired who call me up and they're wanting to take a little extra money out of their portfolio for something like, I want to go buy a car. And let's use the example that they're getting income every month from pension, Social Security, maybe taking some monthly withdrawals off their investment accounts with us. But they call me up and say, hey, Mark, I'm going to go out and buy a new car. I'm going to trade in my car and I need $16,000 in addition to the trade-in because I want to pay cash for this car. I don't want to finance the car. So they know as we're talking to each other that I need to go into their portfolio and actually get $20,000 out of their portfolio. So after we set aside $4,000 in taxes, they can have their 16. Now they're okay with that. They understood that. But here's the problem is what if their income is like right there, right here on the page? And that extra 20,000 kind of puts them right here on the page. What if it does that? So one thing is, yes, it's going to cause you more tax and causing your taxable income to go up, and you're going to pay $4,000 in tax on that $20,000 withdrawal so they can get 16. But what it also does is it causes your Medicare premiums to go up and it causes your Social Security tax bracket to go up. Most financial advisors and home offices of companies, when you call into your investment company and you want to take a withdrawal, they don't talk about how it affects Social Security. They don't talk about how it's going to affect your Medicare premiums. All they do is basically tell you, here's a withdrawal, we'll put it in your bank and there's going to be so much taxes withheld. They tell you about the taxes, but they don't tell you about Medicare premiums or the Social Security tax bracket. Now, next year, what's going to happen is your income kind of goes back into that normal range. But now all of a sudden next year, my Social Security tax bracket is going to be higher. And I just went from the 50% to the 85% because of last year's extra withdrawal I took for a car. Now you saved the money. You deserve the right to go on vacations, have home improvement projects, buy a new car. You should do that kind of stuff. But I also think you should be educated on the consequences, the pros and cons of things. And too many financial advisors don't tell us about all these consequences. They basically just tell us tax and they don't tell us the other stuff. So that's why I wanted to put that on there for you. Let's talk about a couple of goofy terms in the Social Security world. Full retirement age. Now, most people think full retirement age to them means that that's when I'm going to get the biggest check. No. Full retirement age, I want you to think of full retirement age as it amounts to your job. And let's just call it, for today's workshop, let's call it 66. Now, what I mean by that is full retirement age is the age that I turn, and let's say it's 66, where I can collect Social Security, but still keep my job, and my job's income doesn't penalize and reduce my Social Security. So if I'm under full retirement age, I'm like 65, 64, 63, 62, and I want to start my Social Security, I can do that while I'm still working, but if my income's too high, my Social Security starts getting penalized pretty drastically. So as long as you're 66 and older, collecting Social Security and still having a job, that job's income will not penalize you then. So full retirement age is not about collecting the full check. If you really want to know how to collect the biggest check, you wait until 70. So full retirement age has to do everything with your job and whether or not your job will penalize your Social Security. Next one, primary insurance amount, PIA. Now that's a goofy term because when you're retired and you collect your Social Security check every month, you're going to see on your bank statement, it's going to say Social Security. But if you were to talk to Social Security Administration or you do some research on your own, you're going to find out that your Social Security paycheck that you get in retirement time, they call it your primary insurance amount. I call it a goofy term because I have no idea what is insurance about our retirement checks from Social Security. It's just a check. It's a Social Security check. That's what you and I call it. But Social Security Administration calls it PIA. Okay, things to consider that you need to ask yourself regarding Social Security is whether or not I'm going to be working while I collect my Social Security. What's my longevity like? So what's my family genetics like? And then kind of what's my current health history? Because that way we need to plan out how long you might live. Now, of course, we don't know the answer to that, but we can run a couple of different scenarios. Have you died 75, 80, 85, 90, 95, anything in between that you want, it doesn't matter. We can pick whatever you want, and we can try to maximize to live to that point. What's the best Social Security option that you need to select? And here's the big one, spouses. If you are married, if you have ever been married, you have options. You have 567 options. Okay, and I'm going to walk you through some of that some more here in just a little bit. And I see popping up on the screen here real quick. One of the questions being asked is, what is the ideal age to start Social Security? Okay, good question. Really too generic of a question for me to answer. What's the ideal age to start Social Security? I have people come to me that say, Mark, I'm going to start Social Security at 62 because I could use that money. Well, using the money and doing the right thing are two different things. Bottom line is you can start Social Security as early as 62, and that's the earliest you can start, but it's also the smallest amount of money. And every year you delay taking it, it goes up and up and up. The last year it stops growing is age 70. So 70 is my maximum I can get. 62 is my earliest I can get. So earliest and latest is 62 and 70. Every year you delay, it gets bigger. I have people who say I want to start at 62 because I'm afraid Social Security is not going to be there for me down the road. I want to start getting this money right away before the next president or Congress wants to make changes to Social Security. It's going to come back and hurt me. I have people say I should wait until 70. That's my absolute best thing to do. I hear people tell me this is what they should do, and they give me their logic behind it. And it's usually not great logic. It's more like how they feel on something. Now, there's nothing wrong to have feelings, of course, but let us put some math behind it to help you find out how to do this with Social Security. Because if I asked you to raise your hand, would you like me to show you how to get the biggest check out of Social Security? We'd all raise our hands. But that's really not the question. It's not how do I get the biggest check? Because the answer to that question is if you want to know how to get the biggest check, just wait until 70. That's the biggest check that you can get. That'll be the maximum check you can have, and you live out the rest of your life on that big check. But really the question boils down to is, how do I collect the most amount of money out of Social Security in my lifetime? That's the more important question. And the obvious answer with Social Security is not always the correct answer. So sometimes we have people starting earlier than 70 at a younger age because that's better for them. They'll collect more money out of Social Security. And more importantly, we find that the Social Security analysis is really, really awesome for people who only have Social Security or pension to live on. But if you have other assets like IRAs, 401ks, other retirement accounts, in addition to like a pension or Social Security, then we find about those folks doing the tax analysis in addition to the Social Security analysis. What it's going to do is it's going to override the Social Security analysis. It's going to have us do something different because now Social Security is going to be to leverage that to protect your personal assets. You have more money down the road for your personal assets. Because when we die, none of our Social Security goes to our kids and grandkids. It's gone. At my age, let's say if I died today, I never collected on Social Security. Nothing would go to my wife and kids for Social Security. There's no death benefit. There's no account value. Whereas if like my retirement accounts, if I die today, my retirement accounts all go to my spouse, all go to my kids. So Social Security becomes, how do I leverage Social Security to get the most out of Social Security while using that to protect my assets, to make my assets grow more for me. However you're diversified, whatever you and your advisor are doing, make it grow more so you have more for you and more to pass down to your spouse and kids when you're gone. So we'll be talking about that throughout the presentation. All right. This is a life expectancy table that we've seen lots of. We know this. We're all living longer and longer all the time. Okay, question just pops up. Can I collect Social Security off my deceased spouse? The answer is yes. As long as you're not remarried, you can collect off your deceased spouse. So we'll walk you through that, but we need to get your deceased spouse's Social Security information in addition to your information, and we can do the analysis and we can show you how to do that for you. Absolutely. Good question to ask. Okay, 3 things on Social Security. Kind of like retirement is like a 3-legged stool. You have Social Security benefits, you have your pension benefits, and then you have your personal savings like 401ks and IRAs. Now myself, I don't have access to a pension. I never worked for a company that has a pension, so I don't get that. So all of my income is going to come from Social Security and then my personal investments like IRAs, 401ks, Roth IRAs, my stocks, bonds, and mutual funds. That's going to create my retirement income. So that means there's more of a burden on my investments to grow and produce for me since I don't have the added 3-legged stool of a pension, because not everybody has a pension. Okay, now I'm going to talk to you real quick about Medicare. I'm not a Medicare expert, so please do me a favor. Don't write me a question about Medicare, because I'm not an expert on it. I'm just going to talk about Medicare and how it relates to our Social Security. We have an outstanding referral for you for Medicare, all things Medicare, Medicare Supplement, Medicare Advantage. We've got an excellent referral source, so just call us and let us know. We'll be happy to give you a resource to somebody here in town that can talk to you directly on that subject. But on this whole page you're looking at, Medicare is our health insurance. It's what takes care of our doctor visits, our prescriptions, these sort of things as we age. And Medicare starts at 65. It's a really good health insurance program, but we have to pay for it. So where it connects to Social Security is required, whether you want to or not, your Medicare premiums, the cost of Medicare, has to be automatically deducted out of your Social Security check, whether you want it or not. Because Medicare and Social Security are in cahoots with each other, and they want to make sure that you never miss a premium payment, you never miss coverage. So it automatically comes out of Social Security, and you just get a less of a Social Security check. But you know what else comes out of Social Security? Taxes are withheld. So we get taxes, we have our health insurance. It's kind of like our paycheck at work. Taxes and health insurance come out, and then we get the leftover. And that leftover never typically is as big as what we think, because when we're always looking at our Social Security statements, it always seems like it's a lot more than this, but we got to reduce it. So why I'm showing you this on the page is right down here at the bottom. Medicare goes up on an average at 6.94%. 6.9% it goes up. That's the cost. It goes up every year. So that's the historical average. So some years more, some years less, but the average is 6.9%. Our cost of insurance is going up at 6.9. However, our Social Security retirement income goes up on about an average about 1.6. Yes, you heard me right. 1.6% is the historical average of Social Security. So our Social Security pay raise is going up on an average of 1.6, but our Medicare premiums are going up at 6.9. Do you guys see that to be a problem? That's going to continue to eat away at our Social Security checks. Now, when I get to this next page here, what you understand is most people think that Medicare, our health insurance, is based on our health, male or female, smoker status, non-smoker status, my pre-existing conditions and pills and things that I take. No. Medicare is based on one thing, income only. And if your income is low enough, then you'll be paying $148 per month per person between the two of you, so a little less than $300 if you're married. And if you are blessed to have a higher income in retirement, good for you, but then you'll be blessed to pay a higher premium. And your premium can go from as little as $148 per month per person up to $504 per month per person. So we want you to take withdrawals. We want you to live the life you want to in retirement time. We want you to have access to your money. We want to maximize Social Security, but we also want to make sure that we're not causing taxes to go up unexpectedly. We want to make sure that our Social Security tax bracket doesn't go up unexpectedly. We want to make sure that your Medicare premiums don't go up unexpectedly. So like if you took that $20,000 withdrawal to buy a new car and we'd set aside $4,000 for tax and you had $16,000 to spend, well, that also might bump up your Social Security tax bracket, but also might bump up your Medicare premiums. And next year you find all of a sudden your Medicare premiums went up and you're wondering why. Well, it's because last year's income was a little too high and it puts you into another bracket. So that's why we cover that. All right, this is right off the Social Security Administration's website. Social Security Basic Facts, Social Security, April 2014, www.ssa.gov. Let me just read you the part in yellow. The Social Security office is well staffed with very trained and knowledgeable employees. The staff answers questions accurately. However, they are instructed not to give advice. Their job is not to advise, but to answer questions. Right here, twice. Not to give advice, not to advise. That is key, super, super key here. The folks at the Social Security office are great people. I knew one of them at one time myself, who I learned a lot from with Social Security before she had passed. They want to help you and they will answer all your questions, and they're going to answer your questions accurately. The thing is you got to be smart enough to go into the Social Security Administration to sign up for Social Security, asking the right questions. If you don't ask the right questions, then you won't get all of your answers. And they're not going to necessarily voluntarily give you extra information because they can't give you advice. Because there's a lot of things that's going on in our brains, your brain, my brain, inflation, taxes, our investments, Social Security's, pension, all of these things all intertwine, but they can only talk to us about Social Security. So they're not experts on everything else retirement. They're an expert on Social Security. So you ask the right questions, you're going to get answers. I have people that come to me following a webinar like this that told me that their friend went to go see Social Security, or they went to go see Social Security themselves, and this is what they told me, and I would find out that that's not correct. And I'm probably guessing it's not that Social Security told you wrong, it's somewhere there's miscommunication between you and that person at Social Security. What you were asking was not what they understood, or maybe you just didn't realize the question you were asking wasn't what you thought it was, and you got a different answer. Well, we can help you with that because the Social Security analysis is going to make your life a whole lot easier to be able to go right in the Social Security office and have this all filled out and just be able to walk right in and say, boom, I want to sign up for my Social Security. This is what I want to get. So that's pretty fantastic. So they can't give us advice. All right, so while we're on the subject here real quick, let me tell you a story here. I was doing a webinar, came across a lady who scheduled an appointment afterwards, and nice lady, she's retired. She's been widowed now for 3 years. Her husband was older than her, and she was the primary incomer. She made more money than he did, but since he passed 3 years ago, now she's retired. She's been on Social Security now for about 6 months, and she's collecting her Social Security. And she learned a few things from our webinar, scheduled an appointment. We did the Social Security analysis for her, and we talked to her about this. That we told her, we really want you to collect this. We want you to go collect off your husband. She says, why would I stop collecting mine? Mine was higher. And why would you want me to start collecting my husband's, which is smaller? Well, the reason why is if we have you do a switcheroo and go collect off your husband here, then the benefit of that is you collect off of this, allowing yours to be left alone to grow and grow and grow and grow and grow. And then at age 70, when our Social Security stops growing, it's right up here. You can you can go back into Social Security, stop collecting his, start collecting yours, and live out the rest of your life with a much higher amount. And in your lifetime, she was able to collect a lot more money off of Social Security, and she did not know she can do that. And it came back to, why didn't they tell me this? Well, because you probably didn't ask the right questions. So it's very simple for us to do the analysis, send her back into Social Security. She did get that changed, and now she's very happy with that result. So 28% of Americans collecting Social Security are collecting a full benefit, meaning age 66 or later. 72% of Americans on Social Security right now started at, let's say, 65 or sooner. 72% of Americans collecting Social Security started at 65, 64, 63, or 62. They started early for whatever reason. They retired early, they needed the money early, who knows what the reason is, lack of information, but they started early. So when you start at 72, that's the soonest you can start. It's the smallest check you can get, and every year it gets bigger. You've heard me say this a few times. But it doesn't mean that starting early is bad. It doesn't mean that starting later is bad. Finding what is customized to you with your Social Security benefits, with your situation, is the big difference there. So let me show you a little note that we have on the bottom. Only 4% of retirees claim Social Security at their optimal time, leaving $3.4 trillion on the table. That came out on the bottom. It came from the Social Security Administration's annual statistical supplement in 2018. $3.4 trillion on the table, meaning people are not collecting the maximum benefit that they could collect. This is what our Social Security statement looks like. Okay, so for me to do the Social Security analysis for you, I need to gather these three numbers. And what it's going to do is it's going to tell you age 62 number, it's going to tell you age 70 number, and it's going to tell you a middle number, like your full retirement age, or PIA, and that's going to be the middle number. Now again, for today's workshop, we're going to assume full retirement age is 66 for today's conversation. But most people look at this. Okay, what am I going to get down the road when I'm ready to start Social Security? And although that's what you need to look at, and yes, that's what I need to do the analysis, I need that for you and your spouse. I need those three numbers. I need those three ages for you and your spouse. And then for that, I can do the Social Security analysis for you. I do not need your Social Security number. I just need these dollar amounts off your Social Security statement. But what I want you to notice is on your earnings report here, Social Security is going to look at your best 35 years, not your last 35 years. Many of us, by the time we get to Social Security, we have been working for 20, 25, 30, 35, 40, maybe even 45 years, and working, making money, paying taxes, and contributing to Social Security. So Social Security is looking at your last 35 years. Why this is relevant is you get 3 years to correct a mistake. So I go down here on this report down here, let's just say it's 2012, and it shows my income at $45,000. And I'm thinking to myself, that's not right. 2012, I made $54,000, not 45, I made $54,000. I paid tax on $54,000. I contributed to Social Security based on $54,000, but somehow my Social Security report is showing $45,000. That means somewhere in my company, my HR department, the payroll services company that they use, up to the Social Security Administration, somebody had a typo somewhere that didn't report my correct earnings, and I paid more in taxes, I paid more to Social Security than what's showing. Well, I get 3 years to go back and correct this. Now this example here that I'm showing you, this is going back and looking at 2012. I can't fix that. That's obviously too many years ago. So when you look at your Social Security statement, do me a favor, look on that side of it here as well, and look at your last 3 years and make sure that those line up correctly, that shows your last 3 years of earnings history, because it's very easy to correct it if there's a mistake. Very easy to take your report into the Social Security Administration and get that fixed. But for me to do the report, I need this stuff over here on this side. All right, this graph is super important. I don't need you to memorize this graph, but what I want you to do is try to at least memorize the shape of it. Okay, so here's what I'm going to get at. All right, so we're going to talk about Social Security on myself. Because there's two ways for us to collect Social Security. I can collect off myself, or I can collect off of my spouse. So my current spouse, my divorced spouse, my widowed spouse, I'm collecting off my spouse. Okay, and so this is collecting off my individual, myself benefits. If I start collecting Social Security at 66, there's FRA, that's my full retirement amount. Remember, full retirement amount has to do with my job, my JOB. Okay, but if I want to start Social Security a little earlier, at let's say 65, I can, but it's going to be 7% reduced. 7% less than if I'd wait a year until 66. It's 13% reduced if I start at 64, 20% reduced if I start at 63, and 25% reduced if I start at 62. So 62 is the earliest you can get, and it's 25% less than what it would be if I started at 66. Now that's a 25% pay decrease for the rest of your life. So that's a big deal. So the longer you delay this amount goes up. Now, if we wait until 67, it's 8% more, 8% more, 8% more, 8% more. Those last 4 years are going up at 8% per year. That's 32% more just to wait those 4 years. From 62 to 70, that's 57% difference in income. That's huge. Now, again, the biggest check you can get is wait until 70. So here's a story of an example of a guy that attended one of our webinars, scheduled an appointment, came in and talked to us. Now, this nice guy, he's retired from his job, and he's living off of company pension and some rental property that he had. Now, he's a little bit of a stubborn guy. He was pretty much determined to come in and tell me what he was going to do with his Social Security, and he needed me to verify for him that he was thinking and planning to do the right thing. Well, as we talked and we gathered some information, we did Social Security analysis, he came back into the office so that we can go over the analysis with him. And as we went over the analysis, I started noticing a little bit of this in his hands. And okay, that changes things. So I started asking some personal questions and found out that he has Parkinson's. Now, not all of us have diseases, not all of us have medical problems, but this guy's case, he had Parkinson's, and he's had it for a really long time. And he's already at this point way outlived his life expectancy. And if I remember right, I think he was 67. He's supposed to have passed some time ago. But as I asked more questions and got a little bit more personable, what I found out is the last 3 years has been a drastic change for him. A lot more shakes, a lot more medication. Brain to mouth isn't working. Brain's thinking, but the words aren't coming out of his mouth the way his brain's thinking about it. It's drastically affected him. And so the doctors give him best case scenario to live 3 more years. Now, kind of a stubborn guy, but he's already at this point way outlived his life expectancy. He says, I can live past that. Not 3 years. I think I'm going to live 6 more years. But the moral of the story of this was 7 years puts it at 73 because he was 67. He thought he could live to 73. He wanted to collect Social Security at 70. I'm trying to get him to collect it right now at 67. He's like, Mark, you don't understand. I don't need this money. I have rental income and I have a pension. I don't need this. I'm saying, you don't understand. If you don't collect this money, it's gone, it's lost. Okay, so go collect it. And here's why. Go collect your Social Security now at 67. And yes, the check at 67 is smaller than 68, 69, or 70. Yes, it's smaller, but I have more years. And if you're thinking you're going to die in roughly 6, 7 years down the road, I'd rather start Social Security now and collect this over that time than to wait until 70, collect the biggest check, but I only got 3 years worth. And that 3 years isn't good enough compared to starting at 67 and getting 6 years worth. A smaller check, but 6 years worth that end up being more beneficial to him. And I advised him, go collect the money and give it to your kids. Go collect the money and save it in one of your investment accounts, your bank account, save it, and then give it to your kids at your death. Take it and give it to charity. I don't care what you do, but it's your money. You've had all of your life working and contributing to Social Security. You deserve to collect as much as you can. Had I had known you years ago, I would have had you start your Social Security as early as 62. But I'm just meeting him now at 67, so you need to get out and go do this. So sure enough, he did. Sometime later, I ended up getting a nice letter in the mail from him, said that he had signed up for Social Security and he's doing exactly what we had talked about. He's collecting it. He's putting the money, I think, into a CD or something at the bank, some kind of an investment that he had at the bank account. And he's not going to touch it. He doesn't want to give it to his kids right now, but he's going to leave that to his kids when he's gone. So it's going to build up and build up to give to his kids. And he's really thanking me for that because he admitted that he was thinking one way and he was thinking with blinders on, and he really wanted me to confirm it, but I really got him to think outside the box. There's other ways we got to look at this, and so I got him to go start right away. So I had a really nice thank you note for him. So the point of this, when we talk about individual benefits and spouse benefits, and we're on the subject of individual benefits, okay, we want to start Social Security when? Not necessarily at 62, not necessarily at 70, it's customized to you. But every year that we delay, it gets bigger and bigger and bigger and bigger. That's important because the scale I'm going to show you in a few minutes on spouse benefits, the scale is a very different shape. So this is growing constantly from 62 up until 70. Okay, so I talked about full retirement age, and we're going to call that age 66. So here's your income limit. So let's say you're under full retirement age, you're 65, 64, 63, 62, and you're thinking about starting Social Security while you still work. Remember, still working. Here it is, when you're under full retirement age, if your income is under $18,960, you're okay. But if you're 65, 64, 63, 62, and your income is above $18,960 and you want to start Social Security, you're going to lose some of your Social Security, and you're losing $1 of Social Security for every $2 at your job that you earn over the 18,960. So let me just give you an example. Let me make up an example that, let's say I'm 63 years old and my income at work is 28,960. Just an easy number, 10,000 over. So I'm making 28,960 at work. As I'm starting my Social Security, I'm not going to get my full Social Security. I'm 10,000 over the limit, so I'm going to lose $5,000 of my Social Security. So I'm losing $1 of Social Security for every $2 I make over that limit. Now, the year I reach full retirement age, because my birthday is not on January 1st, my birthday is like many of you, it's throughout the year. And so part of this year I'm going to work and part of this year I'm going to be retired, because a lot of people don't retire on December 31st. So that means they spend part of that calendar year working and part of that calendar year being retired. So they give you a bigger buffer at Social Security. Now you can make up to $50,520 that year, and then it's a $1 ratio to $3 ratio. So instead of 1 to 2, it's 1 to 3. So now for every $3 I make over $50,250, then I lose $1 of my Social Security. But once I reach full retirement age, once I get to that full retirement age, now again, I'm using 66 as my example. If you want to know what your full retirement age is, it'll say on your Social Security statement. When you look at your $3 amounts, it'll tell you what the middle number, it'll tell you what your full retirement age is. My full retirement age is 67 and 10 months. So it'll break it right down to the month. But once you reach 66, once you reach full retirement age, there's no limit, no penalty. So I'm 66 or older, I'm still working, and I want to start my Social Security. It doesn't matter if my job's income is $10,000 a year, $100,000 a year, or $1 million a year. I have no penalties on my Social Security because I'm now at least full retirement age or older to collect. So there's no penalty afterwards. There's only penalty to start beforehand. Okay, so I mentioned earlier about the lady who retired. Her husband had passed away. She'd been on Social Security for about 6 months before she saw our webinar, came and talked to us. We did the Social Security analysis. This is what that kind of looks like right here. This is what I call it a change my mind form. You get a chance to go back in and change it. I put this up here because there are times when it's appropriate for you to want to change your option to something else because it's the right thing to do financially for you. And most people think that Social Security is kind of like it's in blood, it's in stone, I can't change it. No, I'm telling you here, when you'll fill out a form and I can change it. But I've also mentioned many times about starting with one option and maybe switching it to another option later intentionally. I'm intentionally starting with the right option, and I'm going to intentionally switch it to another right option later at a certain age. Like the example I gave earlier, to start with taking off my deceased spouse, allowing my own individual benefits to grow. I get to 70, I'm going to go back into Social Security, refile again, stop taking this, start taking my own benefits and living out the rest of my life that way. I'm actually going to show you some math problems on that here in a minute, but we have what's called a change of mind form. All right, so now that we're going to do this, we're going to start talking about spouse. All right, so let's say we're going to talk about Jeremy and Samantha. And the first example I'm going to give you, Jeremy is the primary income earner. Samantha stayed home and raised the family. So she did not work and contribute to Social Security. And if she did work at some point in her life, she didn't work enough, contributing enough to Social Security. So for you and I to be eligible to collect Social Security for ourselves, we have to have worked and contributed to Social Security for 40 quarters. 40 quarters is basically the same thing as saying 10 years. You've had to work for 10 years, pay taxes for 10 years, contribute to Social Security for 10 years, and then you are eligible to collect off yourself. But in this example I'm giving you, let's say Samantha didn't have a job and she didn't work. It's all under Jeremy. So I'm going to show you here how one person worked, but two people are going to collect under Social Security. So Jeremy's primary insurance amount at age 66 is $2,200. But Samantha's entitled to collect half of his. So together, they're bringing home $3,300 of income. So I've seen a question that popped up here on the screen. I've been just kind of waiting for this particular slide. The question is asking me, when my spouse dies, which option do I get? Okay, so it depends. Maybe you started on your spouse's option, or maybe you started on your option. But when your spouse dies, you have the option to go to the higher paying one, moving at that point. Maybe your spouse died earlier, your spouse died later. We have spouse options. So yes, you can collect Social Security off of a deceased spouse as long as you haven't remarried. And so in this particular example, I want to show this to you because Jeremy and Samantha are both alive, and Jeremy's going to collect $2,200. Samantha's going to get half of his $2,200. Half of $2,200 is $1,100. Together, they're going to get $3,300. So they both start right here at full retirement age. He gets $2,200. She gets $1,100. And then together, the rest of their life, they live on $3,300 of Social Security. This is relevant here just because I want you to make sure you see this for several different angles. Because the other angle is, what if one of them dies? Because it doesn't matter if Jeremy dies first or Samantha dies first, the answer is still the same. Whoever is the surviving spouse basically drops the $1,100 check and keeps the $2,200 check. So if Jeremy dies first, Samantha, her $1,100 check that she's getting off of spouse benefits, she'll drop the $1,100 spouse benefits and she'll collect Jeremy's $2,200 widow's benefits. It's the semantics of words, but that's basically what it boils down to. She gets to keep the bigger of the two checks. She doesn't get to keep hers and half of his. That's not right. And that's what a common question I get from folks. Is she just gets to keep the bigger of the two checks and dropping the smaller one. Okay, now that we're still on spouse here. Remember that chart I showed you on individual benefits where it starts as early as 62 and it grows all the way until age 70? And if we start at 62, that's the smallest check. And the amount that we would get is 25% reduced. So let me show you this on spouse benefits. So now this is us collecting off of our spouse, our current spouse, divorced spouse, widowed spouse. If I wait until age 66, I get the full $1,100. And for Jeremy and Samantha, for her, that's $1,100. But if she started at 65 collecting off him, she's going to get 92% of that. So 1,100 is half of Jeremy's. So she's going to get half of Jeremy's, but if she starts at 65, she's really getting 8% less than that. She gets 92% of the 1,100, 83%, 75%, 70%. That means it's 30% reduced. She's going to get 30% less than the $1,100, which boils down to $800. So if she wants to start collecting as early as 62 and collect off her spouse, Jeremy, then she can start as early as 62, but she's going to get 800, not 1,100. Okay, but I want you to see where this stops here. See how this stopped growing? All the way from 66 until age 70, it stopped growing. So example is, got a wonderful client who retired from the state, was a state employee, and retired about 3 years ago. And over the last 3 years, they've been living on his state pension and her Social Security check. Now, he's 68. They're attending the Social Security webinar because his wife was a couple years older than him. And they were thinking about when should he start Social Security. Should he start at 68? Maybe wait until 69? Maybe wait until 70? Well, for him, we wanted him to go ahead and start it right now at 68. He was thinking I would wait because of living comfortably on collecting her Social Security and his state pension, but now he's ready to start his Social Security. He thought about waiting, even though he doesn't need the money. We're going to have him take it now. And what we talked to them about after we did the Social Security analysis is, here's a couple of bad pieces of information for you. Number one, you're 68. And what you're going to collect over here at 68 is $1,100. I'll just use this example earlier. But if you would have started it last year, it was $1,100. If you would have started at 66, it's $1,100. You should have started 2 years ago when you were 66 collecting the $1,100 because over the last 2 years, it hasn't grown. And no, Social Security is not going to go back and pay you back for the last 2 years that you could have collected, but you didn't. Well, Mark, why didn't Social Security tell me this when we went in and filed for my wife? Because you didn't ask the right questions. That's kind of a standard answer. You didn't ask the right questions. So Social Security wants to make darn sure that you and I can never sue the Social Security Administration for them giving us wrong information. Their default answer is, we're not responsible, we can't give you advice, we only can answer the questions. You ask us questions, we will give you accurate answers. But if you start asking questions about things outside of Social Security, of course they can't answer that, but they can talk to you about Social Security. You just gotta know what questions to ask. In this particular case, this client didn't know to ask this. He just thought, we're gonna go in and collect for my wife, and that's all we need. We'll start on hers, and then my pension, that's good enough. We'll let my Social Security get bigger. So I'm telling him, if we start at 68, you're gonna get the $1,100 right now. Oh, and the bad news is, you should, not only should you have gone back 3 years, but there's other things that we could have done if we would have planned ahead. And that all we got to show him that all of that in the Social Security analysis. So he's like, oh my gosh, thank goodness I've met you now. It's better to have met you at 68 instead of next year at 69 or next year at 70. I'm so glad I started talking to you guys about this. You don't know what you don't know. And you don't always know what questions to ask so that you can be an expert to go ask the right questions to Social Security. So that's where we want to come and help you out. And that's why we do things through our nonprofit, so we can help you on taxes and Social Security related things without having to pitch a product and outsell anything. Help you with these things. So spouse options, I can start as early as 62. Just know that it's a 30% reduction. If we start collecting off of ourselves, it's 25% reduced. If we collect off of our spouse, it's a 30% reduced. So keep those two numbers memorized there. So now I'm going to start to show you a little math problem here. And I'm going to walk you through Jeremy and Samantha. And I'm going to change the variable so you kind of have a different way to look at it each time. Now in this example here, Jeremy's full retirement amount is $2,200, that's at 66. But let's say in this example, Samantha did work And at her 66, she can collect $600 a month. Okay, now do you think Samantha wants to collect 100% of her own Social Security? Because 100% of her own Social Security would be $600. Or do you think she'd rather collect 50% of Jeremy and get $1,100? Because 50% of his is $1,100. Now you do the math. Would you rather take the $1,100 or the $600? The obvious answer is not always the correct answer, but when we built this presentation here for you, we wanted to make the obvious answer the correct answer because it'd be a little easier to follow. When you see this applied to your situation with your Social Security, you can definitely see how it's customized to you. So let me walk you through this. So we're going to have Jeremy die at the age of 75 and Samantha die at the age of 82. They're both 62 now, so they're both 62, and they're both going to go in and start collecting Social Security. So collect individual benefits, $1,650. Now where did I get $1,650? Well, he's getting $2,200, okay, minus 25% because he's starting his early 62. Now where are we getting $800? Well, she's getting $1,100 benefits off of him, $1,100 off his full retirement amount, and then she's losing 30% of that, which takes it down to $800. So now they live out their life. He's getting $1,650, she gets $800, both starting at 62, and that's what they're getting. And then they die at the age of 75 and 82. And they would have collected a grand total of $550,000 of Social Security in their lifetime. Now, this is one way. I'm going to show you multiple ways to do this. Now, having said that, let me clarify something here. These are old slides I'm using, old kind of like national slides here in the United States. I find folks that I work with, one or both people I'm working with, husband, wife, one or both, have a bigger Social Security check than $2,200 and $600. I find together that's $2,800. I find a lot of times one person has more than that or both people have more than that. And if your income's higher, then great, these numbers will be exponentially higher too. But using these numbers, and they die at 75 and 82, they would have collected $550,000 out of Social Security in their lifetime. Now let's change one variable. Now we're going to have them still dying at 75 and still dying at 82, but now we're going to start collecting Social Security at full retirement age. So now he's going to get the full $2,200, she'll get the full $1,100, and then you add that all up for the rest of their life. When we started at 62, it was $550,000. If we started at full retirement age, it's $580,000. You see how delaying it a couple years, how they ended up collecting like $30,000 more money? Okay, so that's the goal, is how do we keep doing this and generate? We're going to collect more, collect more, collect more. So let's change the variable again. Now we're going to wait until 70 and start. Wait until 70 and start. His $2,200 goes up at $2,904 because remember, it goes up 8%, 8%, 8%, 8% from 67 up until 80. Or I'm sorry, 67 up until 70, those last 4 years. Where Samantha, she's collecting spouse benefits, and that stopped growing at 66. So she's capped off at $1,100. So he'll get a bigger amount. She still gets the same $1,100, still die at 75, still die at 82. We went from at age 62 collecting $550,000 total, full retirement age collecting $580,000 total, to age 70 collecting $532,000 total. So wouldn't you agree? To get the biggest check is wait until 70, but that doesn't mean that was the right thing to do because they got less money. Because in Jeremy's case, they started at 70 and he dies at 75. He got the biggest check, but he only got 5 years worth. Samantha, she started at 70 and she dies 12 years later, 82. She got her maximum check, but still not the right way to go. So let's change the variable again. So what we're going to do is we're going to still have him die at 75 and her die at 82. So we still haven't changed that. We're going to have Jeremy start at 66 and he'll get his full $2,200. And remember, Samantha worked. She got a little Social Security off of herself. And this is the best part right here. So she had her own Social Security. So why not we have Samantha go here at age 62 and start at 62, collect Social Security and $450. Now why $450? Because her Social Security at full retirement amount, her PIA is $600. And collect off of our own self as early as 62, it's 25% reduced. So minus 25%, hence that's the $450. So she's going to live on $450, $450, $450, $450 from 62 up until 66. And then when Jeremy goes in and he starts his own Social Security, she'll go in with him because we're using this example that they're the same age here. So now that she is 66 and he starts his Social Security, she's going to switch from taking her Social Security at $450 a month to now taking spouse benefits and getting $1,100 a month. So his is still staying at $2,200, but for her, she started early collecting $450 and then stops, go in and refiles, goes from collecting hers to now collecting his, and goes from $450 up to $1,100 a month. So we went from 550,000 at age 62, 580,000 to delay it until full retirement age. It drops to delay it down to 70 to 532,000. And we do a hybrid approach, what we call it, a switcheroo strategy is what I like to refer to it, 584,000. So again, if your Social Security numbers are bigger than 2,200 and 600, well, then your numbers are going to be exponentially bigger here. But you can see how a hybrid approach, where one spouse, we do one thing with one spouse, but the other spouse, we're going to do two options. We're going to start with one and switch to another, intentionally plan to do this, and we get more money out of Social Security. Now, sticking with that, let's change one variable. Now let's have Jeremy live 10 years longer from 75 to 85. Samantha living 10 years longer from 82 to 92. Again, he starts at 66, he collects 2,200. She starts over here at 62, she gets 450. Then at 66, she goes in and switches it to 1,100, $962,000. We just went from 584,000 doing that strategy to 962,000 doing that same strategy, because that 10 extra years made a difference. Now, if you look at this, would you say that this is the best option right here? Now, we don't know God's plan is when we're all going to pass and how long we're going to live. We don't know that, but you can use some reasonable assumption on kind of what's your health like today and what's your family genetics like, how long do the other family members in your family live, so that we can maybe play around, maybe create a couple of these Social Security analysis. We can, like in this case, we create one at 75 and 85. We can create it, whatever you want to do, we can create that. So we have multiple ways to show you Social Security so that we can pick the best option that's best for you and customized to you. So clearly doing some kind of a hybrid approach made sense for dying younger, but for living longer, another approach made sense. Now I want to be really kind of clear on this next thing here, because we're going to start jumping into taxes. So we're kind of done with Social Security for a little bit. I'm going to talk about taxes now coming up, and I'm going to reference back to Social Security. The key on this is if you only had Social Security to live on retirement time, you had no other resources, then the Social Security analysis is always going to be right for you and accurate for you. But if you have other resources and you have money saved in other accounts like IRAs and 401ks, you got a pension, you got Social Security, you have other resources. About half the time, the Social Security analysis, what it tells us to do is accurate, it's customized to you, and it's accurate. The other half the time, it's not accurate, because the Social Security analysis is only looking at Social Security, where the tax analysis is looking at everything. It's looking at your whole financial world, your investments, your rate of return, inflation, taxes, Social Security, pensions, part-time job, full-time job. It's looking at all of that. And so then we're able to go in and say, this is what Social Security analysis is saying to do, what we want to do, but let's not do that. We want to do this. We want to take a different option on Social Security, even though that means I'm going to collect less money from Social Security. That's what I want to do, because it has a better benefit to my portfolio. And here's why. And when you see the numbers side by side, wow, now Social Security becomes a tool. It's a retirement income, but it becomes a tool to maximize the savings of your other investments. Whatever you're doing, if you manage your own investments or whatever your other financial advisor is doing for you, it'll help maximize that. And when you see that side by side of no Social Security planning versus Social Security planning, and then compare that to Social Security planning versus now tax planning with it, wow, it's night and day difference. It's huge. So I put this back up here on the screen because I think it's important to say there are two systems of taxation in our country, one for the informed and one for the uninformed. My goal is to make you more informed. So I'm looking here on the meeting here. It looks like we have a lady on the webinar here. Her name is Stacy on here. She asked an earlier question. I'm not going to say Stacy's last name. So let's just pretend after this webinar, Stacy's going to come over here into my office and we're going to play some cards. I'm going to make this example kind of simple, kind of silly. We're going to play cards, but I've never played this card game before in my life, and she's going to teach me how to play. So in those early games, who's likely to win, me or Stacy? It should be Stacy. She knows the rules. She knows how to play. She should beat me. Okay, I think we can agree with that. But let's say we played this card game now for an hour or 2 hours, and we played this card game 10, 15, 20 times. Now who's likely to win, me or Stacy? Kind of more of a toss-up, right? I could win, she could win. I agree, toss-up sounds right, but she still has the advantage over me. Okay, so I know the rules, she knows the rules. But because she's been playing a lot longer, she's figured out what? She's figured out strategies. Strategies to stay inside the rules of the game to beat me. For example, like tic-tac-toe. You ever play tic-tac-toe with X's and O's? If you're the first person, you always take one of the four corners. Always take one of the four corners. You can't really win if you don't do that. But if you're the second person, you don't go first. You typically want to take the middle spot because you want to block them from winning. So even something as simple as a card game or tic-tac-toe, there's strategies to stay inside the rules to beat your opponent. And that's what this is this is strategies to maximize and get the most out of Social Security. And the next part is to strategize so I can show you, Understand the rules of taxes so you can understand how to maximize my Social Security and minimize my taxes when I do this. So the rest of the presentation is basically condensed down to basically 2 pages. These 2 pages here. Now, taking notes, if you can take a note and you can write some of this down on this page, that'd be outstanding. You don't have to write everything on this page, but if you can make 3 circles, you can make 3 bucket-looking shapes. We call these buckets tax buckets. We call the left bucket tax deferred, the middle bucket's taxable, and the right bucket's tax-free. If you can, on your piece of paper at home, draw out 3 quick buckets side by side and label it tax deferred, taxable, and tax-free. Now the stuff below it, these are examples that you can have under these buckets, and you don't have to write all this out. What I'd like you to write out is at least write out on your paper which one of these things you have under these buckets. So what I want to do with this slide here is I want to teach you examples that come under all these 3 buckets, and I want to teach you pros and cons. When you understand that, then you're going to understand how you can easily reduce taxes in your lifetime. When we do this, I'm going to tell you from my experience of 24 years, the average person that we do the Social Security and the tax analysis for is saving well over $300,000 of income taxes in their lifetime. Taxes that you don't have to pay, but you have the God-given American privilege to pay as much taxes as you want, but you also have the privilege to understand the tax system and learn how to minimize tax. And what I'm going to do is I'm going to teach you things that you can do today, next year, next year, next year, next year, to save yourself a ton of tax for the rest of your life. So this is typically not advice you get from a CPA, because the CPA is all focused about saving tax today and last year. I'm going to teach you things that's going to cause you to pay a little bit more tax right now to save a ton of tax in your lifetime. The IRS has a philosophy. It's pay me now, pay me later. But when you pay me now, you pay way less later. Way less later. If you try to put everything away to not pay taxes today, then you're going to get clobbered later. And when you see this, how this works out, this will make more sense to you. Tax deferred, taxable, tax free. So tax deferred bucket means it gets taxed later. When my money grows, I don't pay tax. I pay tax later down the road when I take money out. At any age down the road I take a withdrawal, I'm going to pay taxes. The middle bucket is what we call the tax now bucket, because when my money grows, I get a 1099 from that investment or that account every year that says I earned interest or dividends or capital gains, and I got to report that on my tax return. So it's taxable every year. In the right bucket, tax-free means tax never. Now that sounds attractive. Tax never means no tax when it grows, no tax when I withdraw it. So let's start with some examples. Now these are common examples. There's plenty of other examples, but these are common examples. In the left bucket, we got 401ks, IRAs, SEPs, Simples, pension, 403b, your Social Security trust fund. So as I put money in here, I get a tax deduction. So let me give you an example of that. There are 3 positives in this bucket. I get a tax deduction, it grows tax deferred, and then I get employer match. So the first advantage here, when I put money in here, let's say I make $50,000 a year, and I want to put $5,000 into my 401k at work. I'm putting $5,000 in my 401k. At the end of the year, I'm paying tax on $45,000 of income, not the full $50,000 of income. So I'm saving on tax. That's called a tax deduction. Number 2 advantage is I get free money from my employer. A lot of times employers will match on their 401k. Employers will put money towards a pension. Employers are definitely putting money towards your Social Security account, your Social Security income. So you're getting free money from the employer. And the third advantage is my money grows year after year after year. It's getting bigger, and I've not paid tax. I've not paid tax on any of this money because it's been growing tax deferred. Another way of saying tax deferred is tax delayed. I'm going to pay the tax. It's just going to be delayed until down the road. Okay, so that's the 3 negatives of this bucket. That's the 3 positives of this bucket. The negatives of this bucket is I have a 59.5 rule, which is 10%. I have a 72 rule, which is 50%. And then I have to pay taxes when I take a withdrawal. So let me walk you through these 3 negatives. The 59.5 rule says if I take money out of these accounts, let's say like my 401k or my IRA, and I'm under 59.5, well, number 1, I got to pay taxes. But number 2, I have a penalty of 10%. If I take out $10,000, I'm going to have $1,000 in penalty because that's 10% penalty. This is the IRS's way, getting a slap on the back of the wrist saying, you know what? We gave you a tax deduction to put that money away towards retirement. And if you take money out too early, under the age of 59.5, you'll pay taxes on that withdrawal and an extra 10% penalty on top of that. So we want to avoid the 10% penalty, of course. The whole presentation, Social Security and taxes. I've told you that several times that the tax part's the best part of the whole presentation. Now, the absolute best part of the tax part is you understanding this rule right here, the 72 rule, required minimum distribution. RMD. If this rule did not exist, then we'd have a whole completely different conversation. But let me explain how the RMD rule works. When we turn 72, now by the time we're 72, we've had money in this left bucket for probably 20, 30, 40 years, growing and growing and growing. We've added to it, employers added to it. This money has never been taxed. The only time we pay tax in the left bucket is when we manually take a withdrawal out of it. And then we only pay tax on what we withdraw. The rest of the money that stays in the accounts is not taxed until later when I take those withdrawals. So the 72 rule says the IRS wants to force us to take a withdrawal, whether you want the money, need the money or not. The IRS doesn't care about your financial situation. Maybe you're still working into your 70s, or you have maybe a younger spouse that's still working and got income that way. You got pension, you got Social Security, you have other resources, maybe rental properties. The IRS doesn't care about that. The IRS cares about two things. How old are you, and how much money do you have in that left bucket? Meaning those retirement accounts like IRAs and 401ks. That's the only two things the IRS wants to know. You'll have your own formula, and your spouse will have their own formula if you're married, because we're different ages and we have different dollar amounts from our spouses. But we are required to take a withdrawal. So let's say, give you an example. Let's fast forward to age 72. I have $1 million saved in the left bucket. The formula is about 4%. I'm required to take out $40,000 this year and pay tax on $40,000, whether I want that money or not. I have to take out that $40,000 and pay taxes on it, or I get hit with this 50% penalty. So if I don't take out that $40,000 withdrawal, I get hit with a $20,000 penalty. Eek, right? I'd rather take out $10,000, rather take out the $40,000 and pay tax on it. And then if I don't need that money, I'll resave it. I'll resave it in something else. Now I can't take it out of the left bucket, pay tax, and put it back into the left bucket. No, that's a no-no. When you become RMD status, you can't take the money out of the left bucket, pay tax, and move it to the right bucket. That's a no-no-no. So when we're in RMD status, required minimum distribution status, we are taking withdrawals from the left bucket, forcefully having to avoid the penalty. We'll take money out of the left bucket, we will pay tax. Whatever we don't need, you're just going to resave it, and it's going to go back over here into this bucket, into these various accounts that you have here. Okay? So I have to take my $40,000 and pay tax on that $40,000, or I get hit with a 50% penalty. Let's say I take out $30,000. Supposed to take out 40, but I take out 30,000. I'll pay tax on the 30,000 that I did withdraw. The 10,000 that I did not take out, but I was supposed to, I just lost $5,000 in penalty. It's a 50% penalty on every dollar I was supposed to withdraw but didn't withdraw. Now, here's the catch. You may have multiple accounts in the left bucket. You don't have to take an RMD withdrawal out of each of those accounts. You can, but that's not required to. Based on your diversification and what you and your financial advisor are doing, you can kind of lump things together and take out $40,000 withdrawal from just one account, not touching the other accounts in that left bucket. You can do that. So long as you take $40,000, that's all the IRS cares, take out that $40,000. Which one of the accounts inside that left bucket? Doesn't matter. A little bit of both, a little of a couple of accounts, all the accounts, or just take it from one, doesn't matter. Okay. Now, if my requirement is $40,000, and let's say I want to take out $50,000, with no penalty to take out $50,000 because my minimum requirement was $40,000. So 50 means more. I'm going to pay more taxes because I'm withdrawing $50,000 instead of $40,000. So it's more tax, but it's not going to be penalized. So just put that in the back of your mind. So this left bucket's got pros and cons. Positive is I get tax deduction, I get free employer money, and it grows tax deferred, tax deferred, tax deferred. The three disadvantages is I got the 59.5 rule, I got the 72 rule, and then I have to pay taxes on all my withdrawals. That kind of stinks. So that's my pros and cons. Now let's switch gears into the middle bucket. We call this the taxable now bucket. So we say left, middle, right. This is what we call these buckets. The middle bucket's the tax now bucket. And now here's some common examples: bank accounts, money markets, CDs, stocks, bonds, and mutual funds. And you probably have some things here. So again, I want you to write these things down. Write down what you have. So in the left bucket, you may say, I have a 401k, I have IRA, I signed up for your webinar, so I have Social Security. And that might be your money in the left bucket. But in the middle bucket, you got bank accounts, and maybe you got some mutual funds over here. Now this middle bucket has pros and cons. Now, the positive of this bucket is down here. There's no rule. There's no 59.5 rule. There's no 72 rule. No rules. Yay. No rules. Okay, so that's the positive. One positive, no rules. One negative. The one negative is I got taxes. When my money makes money, when my money grows, those accounts, if they earn interest, dividends, or capital gains, I got to pay taxes every year. Whether I took a withdrawal or not, whether I spent that money or not, my accounts grew, I got to pay taxes every year. So this bucket has pros and cons. Now in the left bucket and the middle bucket, I gave you examples. Both buckets have other examples. I'm just kind of giving like the most common examples. And I say that because in the right bucket, now as we shift here to the right bucket, tax-free means tax never. Guys, this is all we have is these 4 options. There is no other options out here. We have Roth 401ks, but not all employers offer those yet either. We have Roth IRAs, which are out there, municipal bonds, and then when I say certain types of life insurance, I'm referring to life insurance that has a cash value. So when you're writing this stuff down, if you have life insurance, good for you. But if your life insurance is what's called term life insurance, and the difference between term and a cash value policy is a cash value policy builds up a savings account inside of it. If you don't have that, then you have term insurance. Don't mark it down. This does not apply to term insurance. This only applies to life insurance that's got a cash value build up. Okay, so now you're looking at this. Now this bucket over here in the right bucket also has pros and cons. So let's hit the negatives first. The negative is there's a 59.5 rule. So if I take money out of my Roth 401k or my Roth IRA and I'm under 59.5, I still get that same 10% penalty, just like I do over here in the left bucket. So that 59.5 rule works the same. But the biggest negative of this bucket is the biggie. Lack of knowledge, lack of knowing what your options are. I have people all the time say, well, Mark, I don't qualify. Mark this or that. Mark this or that. No, no, no. Because you may know one rule, you don't know all of the rules that make you eligible. And I very, very rarely ever come across anybody that's not eligible to get money into the right bucket, get money into Roth IRAs a variety of different ways. You just don't know how to do all those, and that's what we do. So we teach you tax law so you can understand law, therefore you can figure out the strategies. Strategies ultimately end up minimizing your taxes. So negative number 1 is the 59.5 rule. Negative number 2 is the lack of knowledge that I don't know how to get money in this bucket. So what's the positive of this bucket? Positive is really good. Positive is tax-free growth. So when it grows, tax-free. Tax-free withdrawals. When I take a withdrawal, it's tax-free. When I die, it goes to my beneficiaries, tax-free. And there's no R&D rules, no 72 rules. You can see right here, there's no 72 rules. Tax-free means tax never. Tax-free growth, tax-free withdrawals, tax-free my beneficiaries, and no 72 rules. Yay. Okay, so now that you kind of see those buckets, I told you that I wasn't trying to pitch a product or sell a product, but let me give you an example of what I'm talking about. So let's say as a financial advisor, I want to sell you, I know, a stock named Amazon. We've all heard of Amazon, or maybe I want to sell you a Vanguard mutual fund or something. If you look in the left bucket, can I sell you Amazon stock or a Vanguard mutual fund someplace in that left bucket? Well, sure I can. I can get them in 401ks, I can get them in IRAs. A lot of times I can get them inside of annuities. I can get them inside of a SEP, a 403b. I can sell you Amazon stock or a Vanguard mutual fund in lots of different places over there. Can I sell you the Amazon stock or a Vanguard mutual fund in the left bucket? Well, sure. There's Amazon stock right there, and there's the Vanguard mutual fund right there. Can I sell you Amazon stock or a Vanguard mutual fund in the right bucket? Sure, it can be in there, and it can be in there. The Amazon stock, the Vanguard mutual fund, that is our product. That is our investment that makes us money, lose money. And we hope we're making more money, of course, but that's what makes them loses money. These buckets that you're seeing on screen, this does not make you money or lose your money. This is me to teach you tax law so you can understand tax strategies so that you can minimize tax. This is not about making money or losing money. This is about me helping you save on taxes. So when you save on taxes, you either have more money to grow or you have more money you can spend. But saving on taxes is obviously a good thing. So I can put Amazon stock or I can put a Vanguard mutual fund in any one of those 3 buckets. But as an independent financial advisor, okay, so let me take the nonprofit hat off for a second, put the financial advisor hat back on. When I work with somebody new as a financial advisor, we're independent. So that means I get to work with you in everything that you have access to. I don't have a home office over me telling me what investments to sell and investments not to sell. Now, you wouldn't necessarily know that, but a lot of financial advisors that have a home office that they report to, there is limits on what they can sell. There's a preferred list of what they sell and other things that you shouldn't sell. Well, me, I'm an independent advisor, I can work with everything. So let's say you come to me following today's webinar and you're wanting to talk about the Social Security analysis, you want to look at the tax analysis as well. But let's say you already own Amazon, you already own Vanguard, and you're very happy with it. I'm going to say, fine, let's keep it. But let's look at it in the middle bucket. So let's say in the middle bucket, you have Vanguard, Amazon, let's say right in here, let's say. Can I take some of the Amazon stock out of that left bucket and move it to this bucket? I have to pay the tax when I do. Anytime I ever take money out of the left bucket, I got to pay tax. But the answer is yes. I can take it from the left bucket, move it to the right bucket, and then go right in there. Left bucket goes right in the middle. I can do that. Doesn't mean I should. Next question. Can I take some of that Amazon stock or that Vanguard mutual fund and move it to the right bucket? Can I do that? Yes, I still have to pay tax to get it out of this bucket. But once it's over here, it'll grow tax-free forever. I never sold the Amazon stock. I never sold out of Vanguard Mutual Fund. I'm still keeping those two investments. I'm just taking some shares from the left bucket, moving into the middle bucket, or I'm taking some shares from the left bucket, moving to the right bucket. And for that, I have to pay tax to get out of the left bucket. But now I can have it in the middle bucket under those pros and cons, or preferably I can have it in the right bucket under those pros and cons. And of course, that's where we really want to go, is we want to take the money from the left bucket, move it to the right bucket. And this is what we call a Roth conversion. So we'll come back to this. Two ways for you and I to get money into a Roth IRA. We can add to it. So contributions means I'm going to add money, or what's called a conversion. And a conversion means I'm going to take money out of one account that I already have saved and convert it to another account that I have over here. I'm just converting existing savings over to another account. So contribution has rules. Number one, I have to have a JOB. I have to have earned income. Number two, my income has to be below this amount. And then number three, if I qualify for the first two, I can put in up to $7,000 per year per person. So $7,000 for you, $7,000 for your spouse. You can do $14,000 per year for the two of you. Now that's a slow process to try to build up money in the right bucket. What we've been talking about this whole time is Roth conversions. And do you see what the rules are for Roth conversions? No rules. That means there's no job rule. There's no income rule. There's no dollar amount limit. So if I go back to this page over here, and let's say I got $1 million in this left bucket. If I wanted to move the entire $1 million from the left bucket, move it to the right bucket in one fell swoop, boom, I can do that. Now that's a ton of tax to pay in 1 year, $1 million all in 1 year. But I'll have $1 million in the left bucket, or in the right bucket, minus the tax. Tax-free forever, tax-free growth, tax-free withdrawals, tax-free to my beneficiaries, no R&D rules. Sounds great. I would never recommend that. And I've found very few times in my career where somebody should do that. Usually what I want to do is have a strategy that's customized to you, like with the Social Security analysis, we want to do it with the tax analysis of based on what your goals are and your timetables and your income needs. We want to take so much right now, whether you're working or retired, take some money out of the left bucket, pay a little tax, move to the right bucket. Next year, take a little withdrawal from the left bucket, pay a little tax, move to the right bucket. Next year, take a little withdrawal from the left bucket, pay a little tax, move to the right bucket. That's called doing a conversion every year. And doing an amount that we can convert every year in a bite-sized pieces so we can trigger a little tax, not trigger a lot of tax, because the little tax we trigger now is going to save us tons of taxes for the rest of our life, tons. Number two is I have more years, because if you start now, you're younger. So let's just say hypothetically you're watching this webinar and you're 60 years old. And let's say you're going to hypothetically die at 90. You got 30 years. If you waited until 72 to follow these rules, when the 72 rules kick in, you got 18 years to deal with it. But if I get you to start now at 60, let's say, now we have 30 years to deal with it. And I have 30 years to stretch out your money. And I want your money to get bigger. I just don't want it to get bigger over in that left bucket. Okay, let's try to prevent that left bucket from getting bigger so we can take some money out and move it over to the right bucket. Take some money out, move it over to the right bucket. Do so in small dosages every year so that, number one, I'm paying a little bit more tax, but not bump me into another tax bracket, not increase Medicare premiums, not increase my Social Security tax bracket, all of those sort of things. Because that rule right there, that 72 rule, is the worst thing that can happen to us. Because by the time we get to 72, most of us have stopped itemizing our tax return, and we are now taking the standard tax deduction. Because the standard tax deduction is clearly going to be bigger for you than the itemized. So when you take that standard deduction, what happens is the R&D rules kick in at 72. You are forced to take more and more money out, and it gets bigger and bigger and bigger. So if I have $1 million today at age 72, and I have to take out roughly $40,000 that I mentioned, by the time I'm 82 in 10 years, it's now going to be $80,000 I have to withdraw. The amount has doubled. By the time I'm 92, it's now about $120,000. It's tripled. This formula starts at 72 and it goes up every year. And when it goes up every year, it causes my tax bracket to go up, it causes my Medicare premiums to go up, and it causes my Social Security tax bracket to go up. And as I showed you earlier before, our Social Security gets taxed one of three ways. And we don't want you jumping brackets all because you hit 72, you hit a bracket, and now these R&D rules kick in, boom, it's causing all these things to kick in. So the sooner in life I can get a hold of you to plan on Social Security and then plan on taxes, it becomes a massive snowball savings of more money to grow for you because you're paying less in taxes. More money to grow, or you have more money to spend. Either way you want to go, saving taxes is saving taxes. So hopefully that made sense here today. We can work with, if we want to get out of Amazon stock, we want to sell Amazon stock, and we want to move it over here because we want to buy Walmart stock, we can do things like that. We want to get out of the Vanguard mutual fund, we want to put it into a Fidelity mutual fund. We can do that too. We can change products, or we can keep your product, but we're just going to take shares of that account from the left bucket and move it to the right bucket. That's called a transfer in kind. I want to keep my Amazon. I just want to move some of my Amazon each year, pay a little tax now so I can save a ton of taxes later. So I mentioned if I was 60, I have 30 years to spread out the tax, so that's good. But I also have 30 years to compound grow my money in that right bucket tax-free. So that Amazon or that Vanguard that's growing for me for the rest of my life, it'll just keep growing from that point on in that bucket tax-free forever. It's tax-free to me, it's tax-free to my spouse, it's tax-free to my kids and grandkids, and I have no 72 rules. Tax-free means tax never. Isn't that awesome? So as we wrap up here, let me just take a quick look at some questions. I noticed a few questions did pop up on here. Okay, a couple questions were already asked about what's the earliest age and the latest age I can start Social Security. So that is 62 and 70 is the earliest and the latest. What tax rate do I pay on conversions? Oh, good question. What tax rate do I pay on conversions? I take money out of the left bucket and move it to the right bucket. We have our tax brackets that we're in. A lot of times you have wiggle room in the bracket that you're in that we can trigger a little bit of stuff and take you up right below the next bracket without going into that next bracket. Again, when it's customized to you, we're going to know where you're at, and we can do things like this to try to figure out how much tax we want to pay today without going into another bracket so I can save substantial taxes for the rest of my life. Again, if that 72 rule didn't exist and didn't force us to do these things, force us to take withdrawals, force us to pay taxes, it goes up and up every year, and it causes taxes to go up, it causes Medicare premiums to go up, it causes our Social Security tax bracket to go up. It's just bad all around. So the sooner we start, the better off we're going to be. So that was definitely a good question. What if future tax laws change is what I'm being asked. Good question on future tax laws. You're always grandfathered in. So there's been talks of tax law changes, and there's always tax law changes. But whatever we do with a Roth IRA and these Roth conversions now, you're always grandfathered under this. Now, if new rules come out that affect us, well, from that point on, we'll have a new game plan for how to deal with those new rules then. But everything you've done up until then, you're always grandfathered under the old rules. So if you believe that tax laws will be changing down the road, then you want to kind of jump on this sooner or later, just because things may change, but you're always grandfathered in. Oh, good question here. What age is it too late for me to consider doing Roth conversions? Okay, good question. Well, here's the easy answer. You're never too late to do Roth conversions. You're never too old to do Roth conversions. You're never too old to save on taxes. So put that in kind of the back of your mind. If you have interest of looking to save taxes, and I'm not talking about trying to help you save in taxes for this calendar year, because that's what your CPA is for. I'm going to try to talk to you about how to save taxes in the next 10, 20, 30 years of your life, however old you are, and save you taxes in that timetable. Okay, and then we will show you in the tax analysis what your world looks like without doing tax strategies, without doing Roth conversions, and then we'll also show you side by side doing the Roth conversions, doing those tax strategies. See that number side by side and map it out using your investments, using everything the same, but the only difference is now we're going to do Roth conversions. Oh my gosh, night-day difference. Huge tax savings. So I encourage that of everybody. So as we kind of go ahead and wrap up in here, okay, we already hit that here. So back to scheduling an appointment here with us. So you want to schedule an appointment with us here, you need to click on the box to schedule your appointment with us. Again, I'm going to recommend the first appointment be a phone call or a Zoom. Probably no need to come in just for a quick introductory conversation. We can't build the analysis in the first meeting because we want to answer your questions you thought about here today, but we also want to get some information from you so that we can do the analysis, and that takes a little bit of time. So the second meeting that we would get to go over everything, that's where I would encourage you to come in the office. And we're essentially located here in town, so you can easily have you come over and we'll go through this in person, but we can also do things in Zoom. But first meeting, phone call or Zoom. Second meeting, Zoom or face-to-face, and I just prefer face-to-face there. So you get to pick a date, you get to pick the time of the day, you get to put in some basic information, put in your first and last name, put in your email address, put in your cell phone number so that we can give you confirmation. We got a lot of people on today's webinar. There's clearly too many people for me to answer all the questions that have been popping up. So thank you for being on here today. Thank you for your questions, and I'm sorry I wasn't able to answer all of them. I'm watching my time. I'm going a little bit long, and I want to be sensitive to everybody watching this, but some of the questions I did read, there are specific questions that I would need to ask you some more information about you to be able to answer your question. So that's part of the reason why I skipped some of those questions earlier. Put in some basic information so we can connect with you, and then you get your confirmation back electronically. It's going to show you the confirmation. And then you're going to get a phone call from Stacy here in my office. Stacy for our foundation. She's going to reach out with you and confirm your appointment. She's probably going to ask you a few questions, gather some basic information from you, just so she can tee us up to be ready for that first meeting with you. She'll tell you what to have handy for you to have ahead of time So like that first meeting, you want to have your investment statements. You want to have your social security statement. If you don't have your social security statement, no big deal. Let Stacy know, and she can email you the social security instructions to go out to the social security website. Keynote here. The social security website is not user friendly. If you do it wrong twice, you get booted off their system and they have to go and unlock it, and that can take you a couple weeks by the time they resend you a password. Follow our instructions. You get it right the first time. Really easy. But if you don't have your social security statement that's mailed to you every year, for some reason you don't have it, let Stacy know and she'll email that to you. And you can go online and get your statement. You can have all that stuff ready for that first meeting, that first phone call, that first Zoom. But she'll confirm the date and the time. She'll confirm the location. She'll confirm what you need to have ready with you. She'll ask you a few other questions just to get us teed up, as well as by you telling us a couple things about you and what was interest to you and kind of what you want us to do here for you. So other than that, I've been talking here for a long time. My voice is starting to go out here just a little bit. I want to thank you guys so much for spending time with this. I'm very passionate about it, as you can tell. I love talking to people about Social Security and taxes. I hope you enjoyed today. I hope after an hour and 15, hour and 20 minutes, you're now thinking to yourself, that was a super productive use of my time. I'm so glad I clicked on that. I'm so glad I saw that. I'm so glad I listened to it. But don't hesitate. You'll have questions that'll sink in afterwards. We want to get those questions answered for you. So we'll schedule our follow-ups. So click that button to schedule our appointments, and we will look forward to visiting with you guys in person. Take care.